As a CFP professional, I've helped many different people in many different situations with their finances. And one common thread that keeps coming back to me is that simplicity in your financial life often pays more than complexity, and it's often cheaper. Now, that isn't to say that everyone has the same situation. Some situations call for more complex solutions. However, let me give you an example. I looked up one of the largest US large cap growth mutual funds, an actively managed mutual fund, by net asset value, and what came up was the American Funds Growth Fund of America, Class A shares, ticker AGTHX. Now, I know American Funds actually has a more reasonable expense ratio than a lot of other mutual funds. So I was curious to see how this investment would stack up compared to a passively managed US large cap growth ETF. I used Vanguard Growth, ticker VUG. I used a tool called Portfolio Visualizer and ran a hypothetical comparison. Let's say you invest $10,000 in the Vanguard ETF and $10,000 in the American Funds actively managed mutual fund on January 1st, 2017, and run that comparison all the way through May 31st, 2026. Important disclaimer, this is a hypothetical back-tested illustration using Portfolio Visualizer. Past performance does not guarantee future results. This comparison is for educational purposes only and should not be construed as investment advice. In this particular hypothetical comparison, the passively managed ETF significantly outperformed the actively managed mutual fund over that period. That $10,000 invested in the Vanguard ETF grew to approximately $51,841 by May 31st of 2026. The actively managed mutual fund grew to approximately $41,585. That's a difference of more than $10,000. Now let's talk about why. These two funds are both in the US large cap growth category, but are not identical. VUG passively tracks the CRSP US Large Cap Growth Index, while AGTHX is actively managed with a different portfolio composition. This comparison is meant to illustrate the potential impact of cost differences over time, not to suggest that these funds are perfectly equivalent. Now, there are a couple of reasons for this difference in performance. One, the underlying expense ratio is a big one. For the American Funds Class A shares, there's roughly a 0.59% expense ratio. Again, this has nothing to do with what is being paid to a financial advisor. This fee comes directly out of the performance of the fund itself. So let's say, for example, the fund goes up 1% in a year. That 1% return is after the fund has already paid itself its fee. In other words, that fund may have actually performed better, but after fees, you as the investor see a lower return, a net of fee return. Now compare that to Vanguard. Vanguard also gets paid for managing the ETF, but the expense ratio is 0.03%. In other words, Vanguard's fee is a small fraction of what American Funds is charging. Vanguard's fee is roughly 5% of what American Funds is charging. That doesn't fully explain the performance gap that we saw, but it is one factor that compounds against investors year after year. There's also the fact that according to the SPIVA report card, through 2025, over a 15-year period, less than 3% of actively managed US large cap growth funds outperformed their index. That is kind of crazy. To be fair, there are actively managed funds that outperform. Some investors may prefer active management for a variety of reasons, but those results highlight just how difficult it is for active managers to consistently overcome their costs and beat their benchmark over long time periods. Structurally, there are also reasons that a low-cost ETF like VUG might outperform an actively managed mutual fund over the long run. There's some tax efficiency built into the ETF structure that mutual funds generally don't have. That means that there can be additional tax drag on a mutual fund's performance if it's held in a taxable brokerage account, compared to an ETF like VUG. There are also sales loads to be aware of. A mutual fund can carry a front-end sales load. Let's say, for example, you invest $10,000 into a mutual fund that has a 5% front-end sales load. $500 gets taken out right off the top. Your investment value immediately becomes $9,500. If you put money into an ETF, you generally don't have that same type of front-end sales load to worry about. Now, there's often confusion on this topic. I'm not talking about paying a financial advisor to manage your portfolio and help with financial planning. I'm talking about the actual investment vehicles themselves. Whether or not a financial advisor provides more value than you pay them over your lifetime depends entirely on what that financial advisor does for you. Now, when I'm looking at a client's portfolio, especially someone who comes to me with investments that are already set up, I'm often asking some very simple questions. How can we simplify this portfolio? How can we reduce the ongoing fees that you're paying? How can we make your portfolio more tax efficient? A lot of times it's very easy to reduce fees within a portfolio by a meaningful amount. At the same time, I'm evaluating whether there's evidence that the higher costs are providing a meaningful benefit. Sometimes there is a reason to leave an actively managed investment in place for tax purposes or other considerations. Maybe a client simply wants some active management in their portfolio, and after they understand the fees and the trade-offs, they decide that's what they prefer. That's completely fine. This is not an argument against all active management, but this is making the point that sometimes a more simple approach like a passively managed ETF can provide more value than the complexity of an actively managed mutual fund. Rather, I think the focus should be on questions like, how can we simplify your plan? How can we make sure that you understand what you're doing and you're confident in it? And how can we lower your fees as much as possible? Also, how can we provide clarity and peace of mind that you're doing the right things? Not add a whole bunch of complexity, and not create more stress, and not add products that don't provide meaningful value to your plan. Thank you for listening. Please hit subscribe. And as always, money is a tool, knowledge is freedom, and planning is power. I hope you have a great rest of your day.